To keep yourself updated, subscribe to Indigo Learn and click the bell icon and download our app OneFin to start learning on the go.
Hello friends, so today we are going to learn about something very interesting. We are going to learn about financial statements, basically how what are the key items or key numbers in the financial statement. We're going to learn about financial statements and the main four components of financial statements. Usually you hear people talking about three main components, that is balance sheet, P&L and cash flow. Whereas I think that there is one more key or rather important component of financial statement, which is ratios or drivers. This is usually, this is more a modeling point from a financial modeling perspective, but it actually helps you understand business, right? So drivers or ratios, broadly let us categorize as that. But first, let us look at these three important elements: balance sheet, P&L and cash flow. P&L is also known as income statement, and even in balance sheet there are various forms in which a balance sheet is prepared. There is this traditional T form of balance sheet and then there is vertical form of balance sheet. So either ways, the content or rather the essence of the financial statement does not change. It is just that the way it is presented. Typically in India we see a lot of people adopting this T form of balance sheet where you have liabilities on one side and assets on the other side. Whereas if you go abroad, it is more vertical form of balance sheet. Even new Schedule 3, what is mandated as per Companies Act, permits you to disclose or showcase your balance sheet as in a vertical form. So for the purpose of our example or our understanding, we'll take the horizontal form of the balance sheet where you have liabilities and equities on one side and assets and all forms of assets on the other side, right? So this is broadly how we have learned as accountants in India. But even if you take the vertical form, it doesn't matter. But let us use this just for simplicity's sake, because it helps me showcase to you how the balance sheet continues to stay balanced, right? So the name balance sheet or the word balance sheet actually refers to a table which is balanced on both sides, right? So I'll try and give you a brief of each of these statements as we go along. And if you're already an accountant or have a background in accounting or finance, you can choose to skip some parts of it, at least the early parts of what I'm going to talk about. But if you're new to finance or if you're new to financial modeling, this is something I would definitely say that you should definitely watch this. Even for accountants and finance professionals, unless you have earlier worked on financial modeling or unless you have done prepared cash flow statements and worked on working capital related stuff, I would strongly suggest that you watch that part of this entire video where we talk about working capital and how it links back to cash flow and all of that stuff. So let's start off on these three primary statements, which is balance sheet, which is position of the firm or an entity or a company, whatever it is, on a specific date. Income statement, which is profit or loss, that is income and expenditure over a period of time. And cash flow, which is again a periodic statement, which is over a period of time. What is the cash flow over a certain period? Let's start off with these, understanding these three, and then we can get into other aspects of financial modeling. And believe me, friends, understanding these three documents or these three components or these three statements, whatever you choose to call them, balance sheet, P&L and cash flow, and along with that, as I said, the overarching component of drivers and ratio analysis, this is extremely important for you when you are creating a financial model. I cannot stress more than this on the level of importance for these these three components of the financial statements, right? So let's get started. So let's take a simple example, right? So all of us, because we are in this whole financial modeling class, let us assume that you've started your own company and we are trying to create a financial model for that. Let's take that, in one of our earlier classes, we had taken the example of this cafe, right, where you own your own cafe. I think that is how we began this entire financial modeling session. So let's take that example and let us simplify it to a large extent, and then let's slowly start adding complex layers to it. Not complex, but let's add more layers to it, okay? So to first up, let us assume that you have started your own cafe, right? And when you started your cafe, you decided that it will be a separate entity. You all know what is separate entity, right? Let's say you form a company and you are very distinct from your company. So you are limited, or your liability is limited only to the extent of shares that you have. That is, once you have given the money to the company, you are no longer liable to the company as a shareholder or to any other external party. right? As a shareholder, please note those words. As a shareholder, you're no longer liable. So assume that you started your cafe, and for the purpose of starting your cafe, you set up a company, private limited company, and in that company initially you contributed 10 crores as capital. So you as an individual have contributed 10 crores to the company, right? So now what has happened to the company? Company has issued shares to you for the 10 crores. Let us forget the face value and all of that for a moment. Company has issued equity shares to you worth rupees 10 crores. Right. Now let us very simply look at a T form of the balance sheet for this particular initial company setup. Assume that there is no cost of setup and all of that. Ignore all of that for the moment. Now, when you look at a T form of balance sheet here, and you look at your liabilities this side and you look at assets this side, when you look at liabilities, when you say liabilities basically includes external liabilities and also what is in vertical form what we call as sources of funds and deployment of funds, right? In sources of funds, what is the source of fund for this particular private limited company that you have floated? In year 1, there is absolutely no transaction, right? Assume that you floated the company on 1st of April of year X and 31st of March of that particular year, the last day of the year, no transaction has happened. You've just put the money. So at the beginning of the year, you put exactly 10 crores, right? And the 10 crores worth of shares have been issued to you. So what happens? In the company's books, again, remember, company is distinct from you, right? In the company's books, on liabilities, that is sources of funds side, right, you have one single line item or entry called equity share capital from Mr. X, you, right? So that rupees 10 crores, that is written. Then on the asset side, right, that is deployment of funds. You have not deployed it anywhere, but what is, you have given the money to the company. So where is that money lying? The money is lying in its, in bank account, right? You have opened a bank account and the money is lying in the bank account. This company has only one line item on either side of the balance sheet. One is equity share capital, other one is cash, right? So equity share, because they have taken money from you, the company has taken money from you, you are a third party, and because you have given the share capital to the company, they are showing you on sources of fund side. And on asset side, or let's say the deployment of fund side, you actually, the company has money lying in its bank account, 10 crores, right? There's only one line item on either side. Very good. So far simple. Now, first year has happened. There is zero transaction. On first day, you put 10 crores, money is lying, end of the year, 10 crores, the balance sheet is balanced, 10 crores here, 10 crores here, done. Now, let us extend this example to year 2. Now, in year 2, let's say you have done a business of, let us say 8 crores. That is, you have purchased food items, because yours is a cafe, food items worth 8 crores and you have sold them for 10 crores, right? Now, in the first year, remember, there was no transaction. So, there is no profit, no loss in cash flow item. We will come back to cash flow, but in P&L or income statement, there is no transaction, because no transaction happened. It's only 10 crores on either side of the balance sheet, and cash flow will come to it independently. But in year 2, you have purchased some items because you had amount lying in your bank account, right? 10 crores. Out of that, you took 8 crores and purchased food items throughout the year. When I say year 2, throughout the year, total purchase of food items was 8 crores and you sold it to customers. You manufactured or you cooked the food and then you served it to your customers and you earned an income of, let us say, 10 crores. So, you purchased something for 8 crores and sold it to your customers for 10 crores, right? Now, here also assume that everything is, cash or let us say bank settled. That is, when you purchase the food items or raw materials or, basically vegetables, fruits, whatever, you have paid immediately. So, entire 8 crores has been paid out to your fruit suppliers or, vegetable suppliers, and 10 crores, whatever you've got everything in the form of, let us say, cash from your customers, right? So, now, at this point, if you look at it, what has happened? Just forget this whole financial modeling and all that concept. You purchased something for 8 crores and you have sold it for 10 crores. On the face of it, you made 2 crores profit, correct? So, let us say we draw the P&L, that is income statement for year 2. How will it look? You have sales, 10 crores, less you have the cost of purchases or cost of goods sold, or there are multiple nomenclature, there are various nomenclatures. For simplicity's sake, let us say cost of goods sold is, let us say, 8 crores, right? 10 crores minus 8 crores, you have a profit of 2 crores. Assume there is no tax, there is no income tax, assume no GST. We'll add all those complications later, right? So 2 crores is the profit. Now, bring back our balance sheet, what we discussed, the T form of balance sheet. You had 10 crores on liability side or the equity share capital and 10 crores in the cash balance. But what has happened? You purchased something for 8 and sold it for 10, you got 2 crores profit, right? So when you get, so this entire 10 crores, whatever you had in your bank account, out of that 8 crores you took, you purchased and then got back 10. So when you took 8 out, the balance was 2. And when you brought back the 10, which is your sales, the balance got increased from 2 to 12. So your balance sheet, your bank account has now increased to 12 crores. Simple. So far so good. And when you make the income statement, in the income statement, you have your sales of about 10 crores, less cost of goods sold of 8 crores, and the net profit is 2 crores, right? This 2 crores income statement is always for a period, right? When income statement is for a period, at the end of every period, all the profit or loss is not retained in the income statement. It is rather transferred to your balance sheet, right? It is transferred from here to here. Where is it transferred? So let us look at it simply. Who is the owner of this particular profit, or whom does this profit go to? The owners of the company. Who are the owners of the company? The shareholders of the company. So this amount of profit, whatever that has been earned in year 2, belongs to the shareholder. So you add this 2 crores to, you create a line item called retained earnings. Here you had equity share capital 10 crores. Below that you add a line item called retained earnings. Why are we saying retained? Because no dividend was paid out. So the money is retained within the organization and it belongs to the shareholder. So 2 crores gets added here. Now what has happened to this balance sheet? You have 2 crores of retained earnings, 10 crores of share capital, total 12 crores. Then on the other side, that is deployment of fund side or asset side, whatever you choose to call it, you have 12 crores in bank account. So 12 balance sheet is tallied, simple. So now let's go to the cash flow statement. I purposely had not explained cash flow statement when I was explaining for year 1 because there was only one transaction. But now let me take you through what happened in year 1. In year 1, Mr. X put into X Limited 10 crores and that money was lying in bank account, right? What is a cash flow statement? A cash flow statement is a statement which shows what is the opening cash, what all monies came in, what all monies came out, and what is the closing cash. It is divided into 3 simple parts for sake of user understanding or investor understanding or reader understanding. It is split. The cash that is coming into the business is split into 3 parts. Going out from the business is also split into 3 parts. Operating cash flow, investing cash flow, financing cash flow, right? In our case, in year 1, what happened? Mr. X invested X, 10 crore rupees in X Private Limited, correct? So what is the activity with respect to the company? When you're preparing cash flow, you have to look at it from a company perspective. For the company, what actually happened? Money came in. Did it happen because of operations? That is, did the company do any operations? No. Throughout the year, there were no operations. Investing cash flow, this is where a lot of people make a mistake. It is not an investing cash flow. Investment for the company. It is not, this money was invested by Mr. X into the company. For him, it is an investing cash flow. Whereas for the company, purchase of assets, purchase of investments, those are all, or sale of assets, sale of investment, they are considered as investing cash flow. This capital contributed by shareholders to the company is a financing cash flow. Why is it financing cash flow? Because the company is availing finance, right? So financing cash flows can be loans taken or loans repaid. Equity share capital raised or equity share capital repaid or reduced, or some kind of capital repayment kind of a program if there is one. Or dividends. Dividends are again paid to the shareholder. So it is a part of the financing, right? Interest is paid back to the people who financed you, right? So lenders, that is basically people from whom you borrow. When I say borrow, it is purely loan, right? Lenders and equity shareholders or preference shareholders, any of these guys come under the financing. They are financing the operations of the company. So any dealings with them, any dealings with respect to raising money from them or repaying money to them or any such activity comes under financing cash flow. So in year 1, the amount of money raised was 10 crores. So that year opening balance of cash was 0. Operating cash flow was 0 because there was no transactions. Investing activities, the company did not do anything, that is also 0. And financing cash flow. What is financing cash flow? 10 crores. So the money that came in was 10 crores. Closing balance of cash is equal to 10 crores. So 0 plus 0 plus 0. 0 is opening, 0 operating, 0 investing plus 10 crores of financing cash flow makes your total closing balance of cash at the end of year is 10 crores, right? So if one were to look at it from a very, bird's eye view perspective, you prepare your P&L, you prepare your balance sheet and P&L or income statement, right, and your balance sheet, and a cash flow statement actually showcases what happened to the opening cash, what all changes happened to the opening cash, and how you arrive at the closing cash. So in our case, because this was year 1, opening cash was 0, closing cash is 10, and it actually explained that your bank account has 10 crores, the same is getting reflected here. Now this is year 1. Now let us keep this aside. Let us look at years 2 cash flow. In year 2, what happened? Opening cash was 10 crores because at the end of year 1 itself, already we had 10 crores in bank, so that is 10 crores. Then what did we do? We actually had operations. In this year, what operations did we have? We had operations of purchases and sales. Right? How much did we purchase? We purchased for 8 crores, we sold for 10 crores, and we made an operating profit of 2 crores. Correct? So we can theoretically say operating cash flow, we can write 2 line items. Sales value 10 crores, less purchases 8 crores, and profit 2 crores. That is one way to write. Or we directly take the profit number from your P&L statement. Just recollect what was the P&L statement or income statement for year 2. We said sales 10 crores, less purchases 8 crores, and profit for the year was 2 crores. So we can take directly that number and put it in the cash flow and say, we have assumed that there are no taxes, right? So we will say profits after tax 2 crores, or operating cash flow 2 crores, right? Then opening cash balance 10 crores, operating cash flow 2 crores, and there is no investing activity. This year we did not do anything, and then there is no financing activity. We did not get any new capital, we did not repay any capital. So the closing balance is 10 plus 2 plus 0 plus 0 is equal to 12 crores. So in year 2, the closing balance of cash is 12 crores, and remember the balance sheet of year 2 where we said the cash balance is 12 crores. Both of them are matching, correct? So far so good. So now you've broadly understood what happens in a cash flow statement and what happens in a P&L statement, what happens in a balance sheet. Broadly, we will get into depths of each of these things, right? The reason why I'm actually starting from the beginning is, there are specifically, as I said earlier, right, working capital is something that all of us have to be very, very careful about, because a lot of people do tend to make mistakes. I've also made multiple mistakes when I was preparing, but slowly over a period of time, you realize that, you made a sign, incorrect sign, or, you just think back the logic and you'll figure out. So just bear with me for a few more minutes and we'll actually run through all the possible changes that can happen to this scenario. Now let's introduce the first layer of complication, right? We said we had purchased something for 8 crores and sold it for 10 crores. Assume for a moment that whatever, food items were purchased for 8 crores, out of that 1 crore worth of stock is still left. So out of 8, 1 is left and we have sold 10, right? So 10 minus 8 is what you spent, 10 minus 8 is what traditionally people would think. But is that correct? Did you sell the entire 8 crores worth of items for 10 crores? No, you sold only 7 crores worth of items for 10 crores. So 8 minus 1, 7, that is your cost of goods sold. You're all with me here? What is it for which you earned this 10 crore revenue? It is only 7 crore. 7 crore worth of items been sold, for which you have got 10 crores in income. So your profit is not 2, profit is 3. Right? Now let's look at the balance sheet and P&L account. So in P&L account, what do? You say 10 crores is the revenue. Then you'll say total purchases 8 crores, less stock of 1, or goods that are sold, that is 8 minus 1, which is 7. Either you say 8 minus 1 here, or you say, in the traditional P&L statement where you put this one closing stock on the, other side, the credit side of the P&L statement. But for simplicity's sake, let us say 8 minus 1 is equal to 7. 7 is my cost of goods sold. So 10 minus 7, 3 crores is the profit. Now let us just go back to our balance sheet. We are still in year 2. Okay. Now what will happen? This 3 crores will come and get added to your retained earnings, right? Instead of whatever was earlier, in year 2, earlier when we did not have the stock, it was 2 crores. Now because we have this 1 crore stock, this 2 crore number will change to 3 crores. So what has happened to your, liability side of your balance sheet, or, sources of fund side of your balance sheet has become 13, correct? How much did you spend? We had 10 crores of cash. We purchased 8 crores worth of items. So 8 crores went out, right? So you have only 2 crores left, correct? But you sold it for 10 crores. So the 10 crores came back to you. So your cash balance is 2 plus 10, 12. So far, so good. You also have 1 crore worth of item in stock. Is that not an asset? It is an asset, right? This is the asset side of the balance sheet. You have to show something on the asset side. Whatever is the asset of the company, you have to show there. So that 1 crore comes and gets added here as closing stock, right? So you have a liability side with 13 crores, asset side with 13 crores, which is 12 plus 1. Here it is 10 plus 3. Total 13. Balance sheet is matched. Your P&L is 10 minus 7, 3, correct? That is also over. This 3 has been transferred here. So P&L account is closed. Balance sheet is tallied. Now let's come to the cash flow statement. So now if one were to look at the cash flow statement for this period, same year 2, right, with this whole stock adjustment and all of that, how would it look? Opening cash balance is 10 crores, correct? So far so good. Then you actually directly take the PAT of 3 crores here. I mean, assume for a moment that it is operating cash flow. But did you actually earn 3 crores? You purchased something for 8, you sold it for 10, and out of that 8, 1 crore worth of items is still left in stock. Correct? So your net cash flow is 10 minus 8, but 1 is lying as stock. Whereas when you directly take PAT here, what have you done? You have treated the entire profit as cash profit. Did you get the entire money as cash? No. 1 crore is still lying with you. 10 is your sale value, 7 is your cost of goods sold. So 3 is the profit, and you also have 1 crore lying with you as stock. Right? So there is some money that is stuck in stock. This is where the concept of working capital comes in, right? Now, what has happened here? Earlier, at the beginning of the year, there was 0 stock. In year 1, there were no transactions, so the stock was 0. In year 2, you have spent 1 crore extra in buying stock, right? So that 8 crores, whatever was, what you used for, purchases, out of that, 7 crore worth of items have already been sold for 10 crores. You got the 3 crore profit. 3 crore profit, it is not cash profit. It is book profit. This one, why? Because this 1 crore is still lying with you. So 1 crore worth of stock is still lying with you. How do you show that 1 crore in your cash flow statement? See, if you directly take 3, right, what is going to happen? 10 crores of opening cash balance plus 3 crores of profit. So 10 plus 3, 13. What does our balance sheet say? Our balance sheet says 12 crores is what is lying in my cash balance or bank balance, whichever it is. 1 crore is lying as stock. So are these two matching? No, they're not matching. Why? How do we make them match, or why are they not matching? So what has happened is this entire 3 crores is not your cash profit, or 3 crores is not your cash flow. For 7 crores worth of item, you sold for 10, you got 3 crores, but you also purchased another, out of the 3, used 1 to buy additional stock which is lying with you. Right. So what has happened here? You have actually spent 1 more crore in buying stock which is lying with you. So if you look at it very simplistically, right, you put 3 here in your operating cash flow, and then you also say 1 crore, that is stock purchased 1 crore extra. So 3 crores minus 1 crore is 2 crores. Hence this 2 crores is what should be treated as operating cash flow. So even though your profit is 3, entire profit is not your cash profit, because whatever cash you got, out of that 1 more crore you went and spent and purchased extra stock. That stock is lying with you as at the end of the particular period on which the last day of year 2, that stock is lying with you. So that stock is not in the form of cash, it is in the form of stock. So the 3 crores what you earned as profit, out of that 3 crores, you have 2 in form of cash, 1 you used to buy stock, right? So that stock in your cash flow statement, you have to reflect that 3 crores is my profit minus 1 crore, which what I have used for buying stock, and hence my cash generated from operations for this period is only 2. 3 profit minus 1 stock which I purchased, which is lying with me, closing, or the cash generated from operations is only 2. Right? So 10 opening balance plus 2 of cash generated from operations or operating cash flow, closing total, your there is no financing activity, there is no investing activity, your total closing cash balance for the year is 12. Right? Now what is the other way to look at this? I'll tell you very, very simply, this is where that fun starts on working capital. What is working capital? Working capital is basically your raw material, inventory, stock, creditors, any trade related items that are constantly changing, and in which money is put in or money is taken out and it is used for operations. Now let us understand this in terms of working capital, right? So what is stock? We've just discussed, what is working capital, any kind of item, which is used in operating the business on a day-to-day operations. It could be your, stock, your cash, your cash is also part of working capital, by the way. Receivables, then your trade payables, bunch of that. All of this forms part of working capital. Now, in our case, in this particular example, stock is working capital. Right? What has happened to working capital? And we have understood this logically that we have invested 1 crore extra, and that 1 crore is lying with us, and hence your cash profit is not equal to your book profit or your P&L profit, and hence you are subtracting that 1 from 3. What is the other way to look at it? What has actually happened? You had 0 as opening stock, and at the end of the year you have 1 crore of stock. So the stock has increased. So how has the stock increased? Because you have purchased it. So you've basically invested money in working capital. That is, when you invest money in working capital, or these are all current assets, right? When you invest money in this current assets, the current assets will go up, and cash, what you have, cash is also a current asset, but your invested money in current assets other than cash. So cash is coming down and other assets have gone up. Just take the same example. Recollect earlier, we said that if, let us say, there is no stock, walk, Jamila, 8 crores you purchased, 10 crores you sold, you got 2 crores profit. Now, same 8 crores, out of 8 crores, you sold goods worth only 7 and you got 3 crores and you sold it for 10 and you got 3 as profit, and you have 1 extra as stock lying with you. So, your balance sheet in your balance sheet, you showed 13 as your liability side, and you showed 13 as asset side, in which you said 12 is cash and 1 is stock. In your cash flow statement, if you were to look at it period to period, if you were to compare the working capital that is changed or the working capital that is increased, right? Stock has increased. Stock has increased from 0 to 1. So you have basically invested 1 crore extra in working capital. Now let us, in this particular cash flow statement, it is just 1. So when you make an investment, it is outflow. So in cash flow from operations, you say 3 as PAT, and from that you reduce 1 as investment in current assets or investment in working capital, and say 2 crores is cash flow from operations, and then add and arrive at the closing cash balance. But if, let us say, there are multiple things, let us say stock is increasing, debtors is increasing, we'll see all those cases, then all those changes will get reflected in this one particular line item called change in working capital. Now, before we get deeper into how receivables are affected, or how trade creditors or vendors and all of that, first let us understand what is working capital, then, or what is net current assets, and then we'll get into that. What is working capital, as we discussed, is all the stock, receivables, then cash and all of that. So if you were to put it on one below the other, the order would be stock, receivables, then you'll have any other receivables that are related to trade, then you have cash, then there are payables also which form part of working capital, their reduction. So your trade payables, the stock you have purchased on credit, so that trade payable is a reduction from your current assets. So that's a current liability. So current assets minus current liability is equal to net current assets, or it is called as working capital. Now this working capital you can show including cash, excluding cash. You usually show cash separately because you are preparing a cash flow statement. In this entire working capital sheet or net current assets, working, you exclude cash and do it, right? So in our case, it is 1 crore is stock. So 1 crore is the net current asset, and there is no current liability. So current liability is 0. So 1 minus 0 is 1. So 1 crore is net current assets excluding cash, correct? Your cash is separately 12 crores is what we have. Right, this equation, right, net working capital or net current assets excluding cash, you just always have to remember stock plus receivables minus payables, trade payables. We'll keep it simple. There could be other elements also, from working capital related stuff. You can split stock as FG or WIP or raw material and all of that stuff. Then trade receivables you can split as more than 30 days, less than 30 days, more than 60 days, all of that stuff. So we'll not get into that for the moment. Very simply put, this is working capital here. Now, let's retain the same 7 crore versus 10 crores example and add one more element. Now that we have understood stock, let us add one more element to this. Now, out of this, 7 crores, whatever you sold for 10 crores, argument's sake, let us take illustratively, you have not received, this entire 10 crore is for one bulk marriage order. You are a cafe or a restaurant or whatever, and it's for one single bulk order that you've got, and all the purchases that you've made are only for this one order. I know it sounds slightly weird. Within the whole year you've got only one order, but just go with me for this example. So this entire 10 crore is only from one party, marriage, reception, buffet or whatever it is, and that as on the last day of the year, the entire money is receivable. That is, you have not got the 10 crores. In all our earlier examples, we took the case where 10 crores money came into you, which is why we said, it is lying in bank and all of that. In this case, assume that entire 10 crores did not come back to you, right? Or the party, whoever to whom you have, served marriage, reception, wherever you have served, they are yet to pay you. I'm not saying whether they'll pay or not pay, that's an independent issue. As on 31st of March or as on the last day of, the period, they are yet to pay you. So, will there be any change in your income statement? Will there be any change in your P&L? Will there be any change in your, your cash flow? Yes, everywhere there will be a change. But in income statement, will there be a change? You had sales of 10 minus purchases adjusted for whatever is the stock, 8 minus 1 is stock, so 7 is the cost of goods sold, 3 is the profit. Has anything changed here? Sales is still 10, purchases is still 8, stock is still 1, so the profit is still 3. So there is nothing that has changed here in income statement or P&L sheet. But on your balance sheet as well as on your in your cash flow statement, there are substantial changes. What are those changes? In your balance sheet, you have taken this 3 as profit, 10 plus 3, 10 your equity share capital, 3 is your profit, 13 it is balance this side. On the other side, we were showing, how much were we showing as, your cash balance? We were showing a cash balance of 12 crores. How did we get this entire 12 crores? We thought that initially there is 10, then you put this, 3, whatever the profit, originally you had 10, then you earned a profit of 3, and then, out of that you put 1 crore in stock, so 12 is balance in that, and 1 crore is stock. But this entire 10 crores of money is not yet received by you. So, you don't have entire 10 crores in cash. Out of the 12, only 2 is in cash. So, we had this 12 crores as cash balance, only 2 is lying as cash. 10 crores is lying as receivables, right? So, why is only 2 lying? So, out of this 10 crores of sales, entire 10 crores is lying here as, receivables. So, your cash gets reduced by 10 and 10 crores appears as one more additional item called receivables, and cash is 2 crores. How is cash 2 crores? Let us see the working. You prepare the cash flow statement, you will know. 3 crores of profit. So, you put the entire profit 3 crores here. So, that is your, starting point. Then, you had invested 1 crore in working capital or in stock. For a moment, assume that stock is the only thing you invested. So, you invested 1 crore, or out of 8 crores what you purchased, 7 crores is what is pertaining to the sale, 1 crore is lying as stock. That is an increase in stock from 0 to 1. So, hence that working capital increase with respect to stock is 1. So, you deduct 3 minus 1, correct? Opening cash balance is 10, then you add 3, then you subtract 1. Then, what has happened? This 3 of profit, whatever was generated, out of that 3, basically, you did not receive any money from your marriage party to whom you have actually made the sale. So, entire 10 is lying as receivable. That is also an increase in working capital, correct? Also, look at it the other way. You initially had 10 crores, income statement profit of 3, but out of that you did not receive the 10, right? You did not receive the 10 what you were supposed to receive from that marriage party. So, that 10 which is increase in working capital is also a reduction. So, what happens to your cash flow from operations? 3 of profit minus 1 of stock minus 10 of your increase in trade receivables. So, you have invested in receivables, that is your cash, you spent the money and it got invested into trade receivables. So, 10 plus 3 minus 1 minus 10. What happens to it? 10 plus 3 is 13, 13 minus 1 is 12, 12 minus 10 is 2. So, your cash flow from operations is actually 3 minus 1 minus 10, that is 2 minus 10, that is minus 8. Cash flow from operations is minus 8. Opening cash balance is 10. 10 minus 8 is 2. So, your closing cash balance is 2. What did we get there in our balance sheet as closing cash balance? We got it as 2, right? These both match. So, whenever there is an increase in receivables or whenever there is an increase in stock. So, here 0 to 1 was increase in stock, 0 to 10 was increase in receivables. That actually leads to a reduction in cash, or that increase in working capital leads to more money going out, more money being stuck with somebody, and hence it is a reduction in your operating cash flow. right? So that is something very, very important, right? Now we've got, we've added stock, we've added receivables. Now let's add the third layer, payables. That is where things will get interesting. Once you get a hang of this entire working capital piece, right, your rest of the stuff will be very easy. And also believe me, this is very, very important. A lot of people tend to make a lot of mistakes when they're, making financial modeling or they're making financial statements. They tend to confuse what is increase, what is decrease, randomly put plus minus, somehow they'll tally your cash flow or tally the balance sheet and go ahead. That is not the way. This is the underlying logic. Let us just add this layer of trade payables and then we'll be done with this. Everything else is some form of derivation of this, stock, receivables and payables. So all other forms of, cash flow, working capital changes will be explained by these three. Alright, whatever happens to these three is something similar will happen to any other kind of current asset or current liability. So let us now look at what happens in case there are trade payables.